Okay, the term money markets is a little bit inaccurate, a misnomer I wrote up here. Because it's not really a market where money is traded, okay? But it's similar to money because they're very short-term instruments and they're very highly liquid. And liquid, if you don't remember, it means how easy it is to convert to cash or real money, okay? So that it's similar to money. They're close to being money. Another way they're similar to money is that usually only the very highest quality, like highly rated or having a low risk of default or low risk of not being paid, are usually included in money markets. Okay, they're usually sold in very, very big denominations of like $1 million or more. So what is that? I'm not sure what that would be in yen. They're not something that normal individuals participate in. They have low default risk, they're kind of low risk, and they mature quickly, they're very liquid. All right, this is money markets. Now, why do we have those? Because really, you might think, well, why don't banks take care of that? And banks do, but banks, as we'll learn throughout this course, they're very, very heavily regulated. So that means they have sort of extra costs. Being heavily regulated gives you extra costs. Right? So actually, it turns out that a lot of the money markets can operate cheaply and more efficiently without having a bank in between. So sometimes they do. You know, banks do get involved in money markets sometimes, but they don't have to. All right, and I think I want to skip over some of the details of this, but I'll leave it on the outline for you if you want to read it later. Okay. All right. So why do we have money markets? Well, money markets are a way for investors, but it could just be a company that has a chunk of money that they want to store temporarily. Okay? It gives them a place to invest or store or kind of keep their money for short periods of time. So big companies like Microsoft or Sony, you know, they may have tens of billions of dollars on their balance sheet as short-term securities. But of course, they want to earn money, even if they're going to store it just for a month or something or a few weeks. They want to earn interest on it. So instead of just letting it sit on their balance sheet, they invest it in the money market. So the borrowers or the investors from the money market get a low-cost source of temporary funds. And companies sometimes use this. Maybe they have some money they want to store, or maybe they need some money for a transaction. They sort of give them a way to smooth out their cash flow when they have big transactions. So suppose, I don't know, Microsoft or Sony needs to make a payment, and it's in 7 days. So they have to get the money together for that payment, but they don't want to not earn anything on that money. They could invest it in the money market and have it mature in 7 days. They get the cash and make their payment. It's like a way for them to short-term invest, and they know it's pretty safe and pretty liquid. Okay? That's what they're for. So money market instruments, the typical ones are treasury bills. It's not really as developed in Japan. Treasury bills are very short-term treasury bonds, U.S. government bonds. But when I call it a U.S. government bond, it usually means a longer-term bond. So a treasury bill is one that's less than a year. The Fed funds, federal funds, I'll go through what each of these are in a minute. Repurchase agreements or repos. Negotiable certificates of deposits or CDs. Commercial paper, sometimes called CP. Bankers' acceptances and euro dollars or euro currencies. All right, and I don't want to overwhelm you, but let me just talk a little bit about what each of them are so that you have a little more than just a name in your head. So treasury bills are U.S. government bonds, but they're short-term. So they mature in less than a year, less than 12 months. Okay, and we'll talk about the term discounting more when we get to really covering a chapter on bonds. So I'm going to skip that today, actually, discounting. They're discount bonds, and we'll come back to what that is. That's treasury bills. The Fed funds rate, do any of you remember that? What is the Fed funds rate? or the Fed funds market? Do any of you remember what that is? Yeah. Yeah, commercial banks use that. Right.
Banks at the end of the day were supposed to have of all the money that they actually get out.
Oh, the money they took as a deposit. Their deposits.
So they need to have that 10%, and if they don't have that 10%, they need to have it as a law, so they will borrow from other banks which do have over 10% over the night. Yes, so just over the night.
Yes, yeah, great explanation. So it's a little market, it's not a little market, it's a huge market that commercial banks made themselves so that they could meet their 10%. One of their regulations is they have to have 10% of their deposits in their vault. Okay. So they just do little loans to each other overnight. It's just completely a commercial bank lending and borrowing to each other, usually overnight, anyway, short term, very short term. Now, something like this does exist in Japan, and it's called the call market. Okay? So the interest rate on the Fed funds market or the call market is called the Fed funds rate or the call rate, and that's an important rate. And in Japan, it might be interesting for you to know, most of the banks that are lending money are the regional banks. Most of the banks that are borrowing money tend to be the big city banks. Okay, and this graph, I just wanted to show you that these two money market rates, the Fed funds rate and the rate on short-term T-bills, kind of moves together. I mean, not kind of, it really moves together, right? Very close together. Okay, how about this one, repurchase agreements? This is important because you need to know this term to understand the case we'll read about Bear Stearns failing. Because this repo market, as it's called, was a key factor in Bear actually failing. Now, these work very similar to the market for Fed funds, but non-banks can participate. And was it Dana asked before, what's a non-bank? It's like a bank, but not regulated like a bank. It doesn't take deposits. So what I call an investment bank or a securities house, something like what Bear Stearns was, or Lehman was, or the other investment banks. They're not really banks in the sense they're not regulated the same. So they're not allowed to participate in that federal funds market. So the repo market is kind of like a federal funds market for non-banks. If you don't take deposits and you don't have to keep a 10% reserve requirement, well, you can still turn to the repo market for short-term borrowing and lending. Now, they work a little bit differently. The firm, for example, Bear Stearns, okay, I'm Bear Stearns, okay, and I have a treasury. Let's pretend this is my treasury bill. So this is my treasury bill. It's a short-term U.S. government bond. Okay, I sell that to you. Okay, I sell that to you and you keep it. Right, and I get some money. Okay, well, I may need this money. For example, we read about Bear Stearns. They need to do that every night to keep operating. Okay, and I use that money for whatever I want to use it for. But I promised him I'm going to buy that back in 3 days or whatever, in 2 weeks. Okay, so it's in this sense, it's a collateralized loan in one sense. What's the collateral? Well, I just gave him the collateral. It's that treasury bill. Right, so if for some reason I don't pay him back like I said I would, well, he at least has that treasury bill. Okay. So it's kind of a collateralized short-term loan. And I think I shouldn't have put this last point in here because it might confuse you. So it's an interesting side fact, but it's not that crucial. Let me show you. There's a nice interactive on what repo markets are through the Financial Times website. So let me show you that. Let me see where we are. We'll come back to that. Do I need to stop the recording to show a video? Okay, those are the most important ones I want to cover, but let me just to go through everything a little bit, talk a little bit about the others. CDs, negotiable CDs. Maybe you've heard of these because now, actually, individual depositors, you can buy CDs instead of putting deposits in banks. So you may have heard of this, CDs. This is a bank-issued security. It's kind of like a deposit, but it just says you're going to keep your money in there for a certain amount of time, right? And it gives you an interest rate in the amount of time. The denominations usually start pretty big, and they go up to be very, very huge. But now I think increasingly they're getting smaller, so even individual depositors at banks can sometimes, instead of putting in a deposit, you can buy a CD. And you get a little bit of a higher interest rate, but you promise to keep your money in the CD for a certain period of time. Right? That's a CD, and again, you can see that for all these money market rates, like the negotiable CD rate moves together with the Treasury bill rate, which moves together with the Fed funds rate. And commercial paper, I just want you to be familiar with this term. These are not secured. They're promissory notes. They're issued by corporations. They mature, pretty soon. They increased a lot in the early 1980s in the U.S. and a little bit later in Japan. They're something that mostly a very big, trusted, well-known corporation can do. You don't want to buy commercial paper from some small, unlisted company that you don't know very well, right? You want to buy a commercial bank from a big company that you know is rated and has audited accounts and stuff. So this is another option for short-term financing for some of those big corporations. Bankers' acceptances are in some ways similar to that, but these are used usually between two parties. They're doing some kind of trade. They're in separate countries. Okay. So company in Japan, wants to sell a product to a company in Thailand, and it's a little bit tricky to get the payment done exactly at the same time. So bankers' acceptances are when a bank, usually let's say for the company in Thailand, will sort of step in and issue a promissory note on behalf of that company. And the advantages are that we don't have to go around and try to collect information on every single company we might want to do trade with. We can rely on their bank to issue a banker's acceptance. So it allows the exporter, like the Japanese company that's exporting something, they get paid immediately, which they care about. They may get shielded from exchange rate risk. They don't have to assess or sort of check out the importer because the importer's bank guarantees the payment. And this is very, very important to international trade, and the role of bankers' acceptances was really important in the kind of decline in international trade that happened after the global financial crisis. Okay, and the last one is Eurodollars. We talked a little bit about Eurodollars last time. If you remember, we mentioned Euro currencies, and I said they don't actually have to have anything to do with Europe. They're just, well, if it's a Eurodollar, it's a dollar deposit, but in a non-U.S. bank. Okay. So if you have a dollar deposit in Citibank Japan, you've got a Eurodollar account. Okay. All right, these are all money market funds. Now, there are increasingly money market, we've been talking about money market instruments. There are money market funds. They work very, you may have heard of mutual funds, which take, a bunch of different stocks. And instead of you as the investor having to pick one stock and invest your money, somebody else will pick a whole bunch of stocks, put them together, and you can buy one share of the fund, and you get diversification automatically. Has anybody heard of that? Mutual funds? Have you heard of mutual funds? Okay, but not that many. Anyway, for those of you who know it, there's a similar phenomenon happening with money markets. So increasingly, there are money market funds, okay? The first one was set up in the U.S. in 1971, and it was called the Reserve Fund. Okay? And it was a fund that took little bits of different money market instruments, okay? Maybe it took some bankers' acceptances, some Fed funds, some UST bills, and put them together. And then you could buy a share of that, and it was already diversified. You could buy a share of this, the reserve fund. Well, these really took off. So this graph doesn't start in 1971 with the very first fund, but you can see that since the late 1980s in the U.S., money market funds grew tremendously. This is a graph that's from the Economist magazine, actually. So by 2008, which is when this global financial crisis kind of hit, money market fund assets were around $36 trillion. Now, how does it work? I thought this diagram might be helpful. Okay. So the money market fund, the example might be this reserve fund, the reserve fund that was the first one ever set up. Okay. Well, it collects money from investors. And those investors really could be anybody. In the U.S. now, if you just open a bank account, you can invest in a money market mutual fund, actually. So it could be anybody. They invest, the fund gets some money. The fund lends that money to corporations, and the corporation promises repayment plus interest, right? And one form of repayment, one way they might do that is they might issue commercial paper. Okay? But it could be a mix of different kind of money market instruments. But most of the funds do tend to be commercial paper. Another big one is CDs, certificates of deposit. Repos are pretty small comparatively. And here's a term I want you to know. This is not something a lot of people know, but I want you to know it so you understand the cases. Money market funds try to keep a stable, what they call NAV, net asset value, of $1. So it's a fund. They're trying to make sure you never lose money, and they want to make it easy for you to see the value. So they try to keep a net asset value of $1. Right? If they don't, they call it breaking the buck. But do you know that a buck is another term for a dollar? So sometimes people slang, they'll call a dollar a buck. Give me a buck. It means give me a dollar. Okay, so if they go below this NAV, which is very rare, it's very rare. In fact, the fund would probably rather put up its own money to keep that dollar NAV. But if it were to happen that it would go below $1, it's called breaking the buck because it goes below $1. Right? And what I want to try to do is show you a video about that because it happened. But I'm going to need a few minutes to kind of get it to the right place. So why don't we take a short break and let's pick up again at 2:05. Just stretch a little bit. All right, let's talk a little bit more about bonds and stocks, and then we'll turn to the mortgage markets, okay? So capital markets are different from money markets in that they're longer term, longer than a year, sometimes quite long term, okay, but longer than a year. They're intermediate or long term financing, okay? And just to review, why do we need these? Because we need a channel to get funds from people who have excess funds to people who don't and want to borrow them, all right? The primary issuers are governments, right? They issue a lot of government bonds, or corporations that issue a lot of corporate bonds, or stocks. All right, the first time that that one of these securities is issued. We call that the what market? Primary market, right? And this is a picture not of a primary market where it's issued the first time, but where it's traded after it's been issued. This is called the secondary market, okay? That's also the secondary market, Tokyo Stock Exchange, okay? So the primary market is for the initial sale, and that's assisted usually by what we call an underwriter, usually an investment bank, all right? And they guarantee a price, and then they arrange the sales to the public. The secondary market is the one you hear about all the time. This is where the securities that have already been issued, they can be resold. Right? And those can be the organized exchanges that I just showed you pictures of, like the New York Stock Exchange or the Tokyo Stock Exchange, but they can also be an over-the-counter market that's kind of quiet, just a desk with some phones. All right, so let's talk first about the bond markets. All right, so bonds, as we talked about last time, are kind of an IOU. All right, so they represent debt that's owed by the issuer to the investor, and there are two kinds. They can be discount bonds, like the short-term treasury bills, or a normal bond that's longer term, has specified payments called coupon payments on specific dates. Okay. So we have corporate bonds, we have long-term government bonds that are called treasury bonds if they're American, or JGBs if they're Japanese. And then we have sort of state or prefectural or local government bonds. They're called municipal bonds. So you can have an Osaka bond, actually, or an Orange County, California bond. Those are called municipal bonds. Right now, the U.S. Treasury bonds are usually considered to have no default risk. And they're still used as sort of a benchmark risk-free rate. Although obviously it's not really true that they're completely risk-free, right? The U.S. has a huge debt-to-GDP ratio, and there have been issues in Congress where Congress has said, no, we're not going to fund, the budget that we already agreed upon. Still, because they're considered sort of the default risk-free rate, usually they have a very low interest rate. So what this graph is trying to show is that under normal times, at least, usually a long-term treasury bond pays a higher interest rate than a shorter term, like a 90-day treasury bill. Sometimes it may not, and you can see that recently that was reversed. Right? And you can think about why that is. So why don't I just leave that as a question for you guys, and we'll come back to it maybe when we cover bonds more in depth. Municipal bonds are issued maybe by a city or a state or a county. They're used to finance public works, like to build roads. They are definitely not risk-free. They do default. So the reason I gave the example of Orange County, California, is that was one of the infamous examples of a default in 1990 of about $1.4 billion. Why do people buy these? Well, they have higher risk, but usually they offer a tax advantage. And then we have corporate bonds. Corporate bonds are bonds issued by companies, okay? They pay interest. It's usually called a coupon payment semi-annually. That you can't just take them in and redeem them at any time. You redeem them when they mature. And the degree of risk varies with each bond. Actually, government bonds, it's the same thing. We have things called rating agencies that sort of investigate the company and give it a rating. A AAA rating means it's very, very safe. And something like a B rating is junk, sometimes called a junk bond, very low. All right, so the risk varies. Here's what they used to look like when they were on paper. Okay. And you can see here, we'll come back to this again later in the course. But the AAA rated corporate bonds pay a lower interest rate, right? So the interest rates all move together. But but the highly rated ones that have a lower risk of default, that are less risky, pay a lower rate, right? And if you're an investor, you know, suppose I tell you that this bond that I have right here, okay, here's this bond. This bond is rated triple B, okay? And I want to sell that to you, okay? So I want to sell it to him. If it's rated triple B, what kind of interest rate does he want? Yeah, because you're worried you might not get your money back, right? At least you're facing more risk than if I tell you, if the credit rating agency tells you it's rated triple A. Okay, so usually the triple Bs have to pay a higher interest rate than the triple As. Okay, but they can all move together for some other reasons. And you may have heard this term, junk bond. That's anything triple B or lower. Who are some of the raters? I think Standard & Poor's, S&P, and Moody's are two well-known raters. You also hear increasingly about Fitch. Fitch does ratings too. Okay. So they may have slightly different terminology, but the basic categories are the same. Okay, and even though, as we talked about last time, you know, if you buy a bond, if you invest in a bond, so Yuki buys this bond, he's invested in a bond. Okay, even if the company who issued the bond, I go bankrupt, it's an IOU. So I still have to pay him if I can get any money left when I sell my assets, right, if I declare bankruptcy. So in a sense, it's less risky in the case of downside risk than a stock, but still, the investors who buy bonds face interest rate risk because interest rates can go up and down. This may be a 30-year bond, and interest rates may go up or down in those 30 years. So you still face some interest rate risk. Yeah. Well, you may not get it all back. So you'll get it. Stock owners get nothing guaranteed. The bond holders may get it all. They may get something. They may get nothing. It depends on whether there's anything left over at the end of the day. But they have priority or preference over the equity holders who know they get nothing. Well, they do if at all possible. So, you know, suppose this were our company here. We have to sell everything. We have to sell these desks. You know, we have to auction off the chairs. And whatever we get, we have to use it to pay our investor who bought our bond. But maybe we can't get very much. In that case, he's out of luck. Okay, so we do have a legal obligation to do that if at all possible. So, and then there are different, we'll get into this later, but there are different kinds of bonds. So you can have like preferred bonds, subordinated bonds, and you're in a different pecking order in the case of bankruptcy in terms of whether you get paid back and how much. Same thing for stock. Okay, how about stocks? Let's talk just a little tiny bit more about them too. So these again are not IOUs, right? So if the company goes bankrupt, you don't get anything because all that is, it's a share. That's why it's sometimes called a share. Okay, so here's my stock. And I sell this share to, what is your name again? Okay, so I sell my stock or equity or share to Mifui. So she now owns a small little share of the company. Okay? If the company performs terribly and files for bankruptcy and is not worth anything, she owns a little tiny share of 0 because I'm not worth anything now, right? So it's kind of risky. And our bondholder, who will be Claire, you know, so I also issued bonds. She bought my bonds, and I go bankrupt and I'm worth 0. Unfortunately, you have a little tiny share of 0, which is 0. Well, she still has that IOU. So if her lawyers, whatever, can get any money at all out of me by selling the shares, by auctioning the clothing, whatever, then she'll get something. Then she'll get something. But she gets nothing. Because she owns a share of the company. Okay, so normal stockholders, as I said, there are different kinds of bondholders, right? We have like preferred and subordinated. We have the same thing with stocks, but let's just say normal, standard stock. Okay, so a normal kind of stockholder, shareholder there, she has a claim on all firm assets if they're worth anything. She has a right to vote for the board of directors, and there may be some things she has a right to vote on too, special things that come up, she can vote. And she can get a return in two ways. Mostly, especially in Japan actually, you probably think of, how do you earn money by buying stock? Well, you hope that the company does well, and the price of the stock goes up, and then you sell it to Alyssa. Okay, you sell it to Alyssa. Now what is this? Is this a primary market exchange or a secondary market exchange? That's a secondary market. So I only got money the first time when I issued it. Okay, but if I then do well, the company does well, the price goes up, maybe somebody else wants to buy it on the secondary market. Well, she just made what we call a capital gain because she sold it for a higher price than what she paid for it originally. So that can happen. The other way she might get money while she still holds it, but now it goes to Alyssa, is U.S. companies very often issue dividends. Japanese companies do it less. But usually if I'm doing well and making money, usually I would issue some dividends to my shareholders. So depending on the portion, the amount of shares that you hold, you get a little bit of money as a dividend, as a payment every year. So you can get a return in two ways, through dividends or through price rises. And it's up to the company whether they want to issue dividends or not. That's up to them. The price is, of course, determined just on the secondary market, what other people think it's worth. Okay. Google, I think that example I had was Google, and the reason was that when they initially listed it was interesting. So the first day, they went from $85 to $100 in the first day of the IPO. And then a few years later, they're worth 6 or 7 times that amount. So whoever got lucky and got in on the IPO, the initial public offering of Google, did very well because of the price rise. Does anybody have some of you have smartphones. You want to check what Google's at now? See, I always use Yahoo Finance, and the Google symbol is GOOG. Okay, so they've gone down since 2007. Another thing I might mention here, they decided to list on NASDAQ. Does anybody know why they might do that? Yeah, I don't know why, they just do. So instead of going on the New York Stock Exchange, they tend to go on the NASDAQ. And then Japan used to have of course, the Tokyo Stock Exchange, but also a JASDAQ. But I think it didn't do very well. I don't think it exists anymore. But anyway, in the U.S., the IT companies, even if they're big, like NASDAQ usually used to handle kind of smaller firms that weren't as big, but the IT companies all go in there, even if they're big. Just a cultural thing, I guess. Okay, and there are two kinds of stock. So common stock is what we've been talking about so far. You get dividends, you get a right to vote if you want to. If you just own one share, you're not going to go vote. But if you own a lot of shares, you go vote. There's also preferred stock, and this is just important because it's in your cases. When the government, bailed out the banks, they bought stock. Well, they didn't buy normal stock where they're going to vote and stuff and get dividends. They bought preferred stock. So they are guaranteed a fixed dividend. It's not up to the company whether they get one or not. And usually they don't have to have voting rights or they don't vote. That's what preferred stock means. It's a little bit different. Okay. The rest of this on stock markets is mostly kind of institutional detail that we talked about a little bit last time. But the organized exchanges are the ones you hear the most about, okay? Usually, small firms, the requirements are usually beyond the capacity of a small firm. That's why bank loans are so important. One of the reasons why bank loans are so important. Because only big firms can list on these organized exchanges. NASDAQ is an example of an over-the-counter market that's very big and important. And it used to be for what you might call thinly traded securities that don't trade too much. That's not really so true anymore. So Google is obviously pretty actively trading. It's not listed on NASDAQ. Just the IT stocks choose that for some reason. ETFs are just a term you might want to know about. Exchange-traded funds. These are not just one stock that you buy, but a basket. So it's already diversified. But you can buy a share in the basket, in the fund, on a major exchange. And they're indexed to some kind of portfolio, like they might try to follow the Nikkei 500 or the S&P 500. The Nikkei 225 or the S&P 500. And they've sort of taken off in popularity because everybody knows what's in there. And so we know how it's going to be valued. And then indices are what you usually hear in the news, right? So if you're watching the news, almost all the news shows, even if they're not really economics or business, they'll say, if it's an American show, what the Dow Jones Industrial Average is, what the S&P 500 is, the NASDAQ Composite. In Japan, you might hear about the topics or the Nikkei 225. What are these? These are just indexes where they pick some firms and they include the firms in the index, and then they'll look at sort of the value of the firms that are in that index. So this is, for example, 30 companies that are in the Dow Jones Industrial Average. Okay. This is the topics 30 for Japan. Okay, and given its size, actually, one thing we learned from the global financial crisis is that there probably wasn't enough resources to really regulate it very well. But the primary regulator is the SEC, Securities and Exchange Commission. And they are very understaffed and very underfunded given the importance of what they do. But you'll see some references to the SEC in some of the cases that we read. So that's their job. They regulate the stock market. Okay, now I want to talk about mortgage markets. Mortgage markets wouldn't normally be covered, I think, in a course like this. But mortgage markets, which used to be kind of boring and covered by specialists, in 2007 became very exciting and important to everybody who wants to understand financial markets and banking. Right, so is it okay? Can I keep going? Can you keep listening and give some attention? This is unfortunately not in your book at all. But you can get the notes on Moodle. Okay. And for those of you who are in here for the first time, now I'm put up on the board there. The Moodle enrollment key is banking with a capital B, so you can get the lecture notes there if you've got some. All right. You know what a mortgage is? What's a mortgage used for? What is a mortgage? Even if you don't really know, you've probably heard it before, right? What's a mortgage? Yeah. Maybe you're talking about getting a second mortgage or something. When you first get a mortgage, when you mortgage a house, yeah, that's different. That's a little bit different. What a normal mortgage is, if I have a mortgage, Yeah, that's interesting. Okay. If I have a mortgage, or if I take out a mortgage loan, all that is a loan to buy a house. It's just a loan to buy a house. But they have some sort of special features. Okay. So is it equity or debt? A mortgage. It's a debt instrument. Okay, it's a debt. It's a loan. Is it collateralized or uncollateralized? It's collateralized by, what's the collateral? The house, right? So I take out a loan, I take out a mortgage to buy a house. It's collateralized by the house. All right? That means if I don't pay my mortgage, somebody can take my house, right? It's collateral. Okay. That's the basic of mortgages. Oops. Okay. And this is on the middle page too, the investigative definition of mortgage. Okay. So you got your borrowers, your collateral, and your lender is usually somebody who's good with people who works for the bank that goes to bank. Okay. All right. Now, how are mortgages different from stocks and bonds? Well, the borrowers are very different because often they're individual people, they're individual people. So they're not governments or big companies. Okay. 2, they're secured or they have collateral, which is the house. Okay. And 3, here's the thing. Getting this secondary market. Okay, so for stocks and bonds, like I did my IPO here, and I issued a bond here, and then she sold that on the secondary market, and let's have Claire sell hers too on the secondary market. And these secondary markets are really, really active. I mean, any day you can buy or sell in a developed country on the stock or bond market. But for mortgages, that didn't really happen, right? So suppose he got married, he's about to have a baby, he wants to buy a house, right? I'm a bank, I give him a loan, okay? And he's got his loan. Well, there wasn't really a secondary market where he could sell that loan. It existed, but it didn't really develop very well on its own. And why? Well, the reason was they're all made for different amounts and for different maturities, and so getting a secondary market sort of organically to develop on its own was hard. And that's the thing we're interested in. Okay, but let's come back to that point 3. How do we determine the rate? Okay, so I made a mortgage. What determines the rate? Well, a lot of it is just whatever happens to be the macroeconomic situation at the time. What's the long-term interest rate in general? Okay, that is one thing. The term or the length of the mortgage. Do you only need 10 years to buy your house? Do you need 20? Do you need a 30-year mortgage? Are you already 60 years old and you need a 40-year mortgage? So the term of the mortgage makes a difference. Longer term is usually higher. Let's come back to the discount points. And the main thing is, I know I've seen you before, but I forgot your name. Toshi. So Toshi gets a credit score. And that's one important thing that determines the interest rate that he pays on the mortgage that I give him, a mortgage loan, his credit score. Okay, so let's go through each of these a little bit. So mortgage rates kind of tend to track with long-term treasury bond rates, okay? And the long-term treasury bond rates are higher, but they tend to have a little bit of correlation with like the Fed funds rate. Okay. So here's the long-term treasury rate, and you can see, kind of mortgage interest rates kind of move along. But these mortgage interest rates are for all different terms. Could be 20 or 30 or 40. So it's not really perfect or smooth, but they tend to move together. The term, okay, so 30-year mortgages have a higher rate than 15. Now, whoever is your lender, okay, if you pay higher fees up front, or if you make a bigger down payment up front, you get what's called discount points, and then you can pay a lower interest rate. That's another way to get your interest rate down. and the borrower's credit score. Okay? So a higher credit score, if Toshi has a very high credit score, then he gets a lower interest rate. Because it means that I think he's a pretty safe credit risk. He has a high credit score, means he's safe. Okay. Well, how does he get that? Well, the most common credit score that we all kind of know now, because you've heard it in the news, or I don't know about you all, but a lot of people have heard it in the news, is called a FICO score. It's called FICO because of the company that came up with it. All right, and they came up with these different factors that they thought were related to the likelihood of a borrower defaulting or the likelihood of a borrower repaying. All right, so what kind of things do they think were in there? Well, how much debt the person already has, which is that pink one, but also payment history. This was an interesting thing. So if you've taken out loans before and you repaid them, then that payment history, which is the biggest portion, that would get positive. You would get a higher score. The length of your credit history, if it was longer, you get a higher score. So this FICO score was one way. You've probably heard this term, subprime mortgages. This is important for understanding the crisis. Well, a subprime mortgage is a mortgage that's made to a borrower that's pretty high risk, which means they have a low FICO score. So they have a low FICO score, they're pretty high risk. And usually the subprime mortgages would charge a higher rate, right? Because it's a riskier person, a lower FICO score. So they pay a higher rate than on a conventional mortgage. The subprime mortgage market grew, and right before the crisis, so in 2004, 5, 6, it was nearing, or over in 1 year, $3 trillion in terms of originations, not outstanding, but like an origination is when a new mortgage is made. So $3 trillion annually in originations. And they were getting up to be like 20% of total originations. So maybe 80% of the mortgages originated would be to borrowers with prime or pretty high FICO scores, but about a fifth would be subprime mortgages to these borrowers that had low FICO scores. Okay, so it grew. It grew a lot. Okay, why? Why did that happen? And there are a couple of reasons. One is just that housing prices were getting really, really high. So here's one measure of normal aggregate inflation, which is the GDP deflator, if you remember from macro what that is. Okay? And here is the housing price index growth rate. And it's percent per annum, which means per year. And so it was rising at a rate of like over 10% since, what is that, 2003 or 4. It was getting very, very high. Why would high house prices lead to more subprime mortgages? Do you understand why? Yeah, so if I'm a lender, if I feel pretty confident housing prices are going to keep going up, well, I don't care whether he's risky. If he doesn't pay it back, I have his house, and it'll be worth more money. Okay, so there were more and more of these kinds of loans being made. That was one reason. So if you remember, Japan had its own kind of asset land bubble, right, real estate bubble. So in 1990, this is a commonly cited statistic. The Imperial Palace, right, that little chunk of land in the middle of Tokyo, okay, was worth over $5 trillion US at current real estate prices, which is a lot of money. You may not know like how much 5 trillion is. Well, it was worth more than the entire state of California, which is pretty high value real estate. It was worth more than the entire country of Canada. I'm sorry if you have any Canadians in the class. You know, it was overvalued though. It was probably overvalued, right? Well, at the height of the U.S. Real estate bubble, that was reversed, because by that time, Tokyo's real estate bubble had popped, and the estimated market price of the Imperial Palace was down to, was still high, but maybe more reasonable, $1.7 trillion. But the state of California was worth $6.5 trillion. California was one of the states where the housing bubble was the worst. Okay, so there were, in this climate, a lot of subprime mortgages being made. So one is high house prices. What else? Why do I have this graph up here? This is the Fed funds rate. What was happening right before the global financial crisis, or the subprime mortgage bubble burst? Right in here. Well, interest rates were very low. Okay? For this reason, a lot of people blame the Federal Reserve, the Fed, the U.S. Central Bank, and in particular Greenspan, for contributing to the bubble. Because the Fed funds rate, if you remember, that's just the rate, right, on overnight lending between banks, lending and borrowing between banks. But the Fed, or the central bank, has a lot of influence over the Fed funds rate. A lot of influence. So the Fed was encouraging lower interest rates, and that meant that mortgage interest rates in general were following that trend and kind of falling. So that contributed also to the growth in the subprime mortgage market. That was one factor. All right, and here's the main one, and I'm going to have to explain in a little bit. The main one was that some very clever investment banker came up with a way to create a secondary market for mortgage loans. And one thing that I hope you understand at the end of the course is that is not all evil people without any morals trying to screw the rest of the world. You know, there were very genuine reasons why we wanted that. And if you know, we hadn't had the global financial crisis, it might have been viewed as a good thing. But anyway, they came up with this clever and turned out to be disastrous way to develop a secondary market for mortgages. And that is called the originate and distribute model. So there was a new model. And under that, let me take back my stock and my bond, and I'll pretend they're a mortgage contract. So I'm going to make a mortgage. How do I pronounce your name? Right. Bobu? Bob? Bobu. Okay, Bob wants a mortgage. Okay? I am the bank. Okay? So I check him out. I check out his FICO score. I decide to make him a loan. Okay, there's your mortgage. And I will take your house here. Thank you very much. And you're going to make monthly payments to me for 30 years, let's say. Okay. Actually, I did it the reverse, didn't I? I did the reverse. So what I get him to do, he has to sign his name on that mortgage contract, okay? Promising to pay all this money over 30 years. And I take that, right? And I now have that. I have this mortgage contract he signed. I gave him the money so he can buy his house. And I have his collateral, his house, in case he doesn't repay. Okay, I'm the lender. I'm the originator. The origin of the loan. I'm the originator, the bank. The mortgage lender. Okay. Well, what happened under the originate and distribute model, you know, in the old days, who would I be the originator? Well, I would probably be a very local, small bank, you know, in the neighborhood, and I knew him and his family probably very well, and I'm not going anywhere, and he's not going anywhere, and we're going to know each other, and I'm going to collect payments every month for the next 30 years, so we're going to know each other even better. That's how it used to work. And I would maybe be a special savings and loan, maybe, or to have it in Japan too. But what happened now was that more and more, maybe I was just some new mortgage lender, like, I don't know, Countrywide is a good example. Okay, I I'm not really particularly based in this area. I don't particularly know him. But I take his mortgage contract, and immediately I resell it on a secondary market. So I find some people, you want to invest in my new product? You know, I got it rated, whatever, and I get maybe all these people, okay? And you're all going to buy a little share of my new financial instrument that I've invented. And you're going to own a little share of that. So I immediately kind of get rid of it, distribute it. So I originate the mortgage, and then I immediately distribute. And this is how it works. What was one good point about it, though, is that maybe I need to get out my Hello Kitty play money. You know, if I do this exchange, right, so he gives me the contract, I have to give him the money so he can buy his house. Okay. Then if I turn around and I get all these investors to invest in my fund or my shares or whatever I'm doing with this, they all give me money. Okay, well then I can turn around and I can say, hey, you want to buy a house? Well, now I have some money. I can give you a mortgage too. So you just sign there, you take out your 30-year mortgage, and now I've got another mortgage. And the good thing was it allowed me to give many, many more mortgages because I have a lot more cash freed up to do that. So I can do a mortgage here, and a mortgage there, and a mortgage over there. And this is not, you know, a bad thing. It could be bad if they don't repay. It turned out to be bad. But it didn't look bad at first. It's not necessarily bad. Let me say it that way. It's not necessarily bad. Okay, so the originator makes the loan. The securitizer, who I didn't kind of introduce in this little example, collects a lot of the loans together and makes up a new security. And then the investor, which is my group sitting in the back there, they invest in that new security. Okay, so let me show you some pictures of how this might work. So we've got our borrower, who is Bob over there. We've got our originator, who is me, Countrywide Financial. I'm a mortgage lender. Okay, then we're going to take a securitizer. I don't know who that might be. Okay, but I'm going to take a whole stack of these. I mean, I've got so many mortgages here, right? And I'm going to give them to our securitizer here. Okay. Now what he will do is he will chop those up into like different groups, right? And he'll make different kinds of securities. And maybe he'll get them rated. Here's our credit rating agency over here. Is going to look at those and assign them a rating. Okay? And he'll make one group that's rated A to AAA, pretty safe. Okay? He'll make one group that's junk. And he'll make one group that we call equity tranche, so it sounds nicer, but it's very highly risky. Okay, these are like the subprime borrowers. So we've got 3 different groups. And now, here's our securitizer. Well now, and here's our rating agency, okay? See there? They rate it. And then our securitizer goes over to our group of investors sitting back there and says, you know, not only, so we have the benefit of being able to make more mortgages, but we have another benefit. We've got investors who want to invest money. Well, they can buy whatever kind of security they want and take on the amount of risk that they want. And presumably our securitizer here will pay, who gets higher returns, in a sense, among this group. The equity tranche, right? Because they're taking on the real risk. So if you really want to take on real risk, okay, buy our equity tranche, and we'll give you high returns. If you want to stay pretty safe, you can buy our AAA rated by, I don't know, Moody's, S&P, Fitch over here. You get a lower return, okay? So there were a lot of benefits to everybody from this system. This is called originate and distribute, and this is what was new about mortgage markets. Okay, so here are some examples of who did this. Lehman Brothers, you know, bought a lot of these, invested in a lot of these. Countrywide Financial originated a lot of these. And Freddie Mae or Freddie Mac, who you might have heard of, they distributed a lot of them. Okay. But it was tricky the securitizer had some real challenges. What were the challenges? As we said before, all those mortgages were for different amounts. All those mortgages were maybe for different terms. All of them need to be serviced, which means somebody needs to go and say, hey, where's your monthly payment? You have to make sure people are paying them and track them and make sure they're paid. Now, they have default risk, right? Because some of our borrowers may not repay. That's always the case, though. But mortgages have another risk that you might not think of. Mortgages also have prepayment risk. Why? Well, if somebody decides that they want to pay their mortgage early, that means that over those, they don't really make payments for the full 30 years. Maybe they pay it in half that time, 15 years. That sounds really good. It is, because it means there's no default. But it has a downside that they don't pay as much interest. Right? So every time you make a monthly payment, you're paying principal and interest. And if you do it for 30 years, I get more interest. If you could do it just over 15, I get less interest. So there's a little bit of prepayment risk as well. So it's kind of tricky, securitizing. Right, let me see. There's a lot of information in these notes. And some of it I want to leave for you to look at if you're interested. But some of it you need to understand the cases. I think this is too much, though. Maybe I want to stop here. Let me just introduce two names to you. Fannie Mae and Freddie Mac. Okay. Here's Fannie Mae. Their business is the American dream. What's the American dream? Well, it's home ownership, according to Fannie Mae. And it is. I mean, a lot of, if you do surveys and you ask most American families, at least before this crisis, they felt like owning a house was part of making it in the U.S. And their sort of sister or brother organization was Freddie Mac. Also, 90% of Americans say home ownership is an important part of the American dream. I don't know if that would still be true now, but it certainly used to be. I've never lived in a house I own, and I'm old, right, compared to you guys, and I have children, I'm sort of settled. I've never owned a house. But every single one of my friends, I cannot think of a friend of mine that, for example, I went to high school with, does not own a house. And they're big, they're big houses with swimming pools and guest rooms. I mean, it's a big difference maybe between U.S. and Japan that you hear about. But if you go to the U.S. to study or something, you'll really experience it. Home ownership. A lot more people own homes and have mortgages. Okay, so the sister or brother organization of Fannie Mae is Freddie Mac. Okay, and Fannie Mae and Freddie Mac, it's sort of tricky. They were the government helped them start out, but they're privately owned. But anyway, they got very involved in the securitization and developing the secondary market for mortgages. And the reason was, part of their mission was to help people to own homes, help people who couldn't get a mortgage to get a mortgage. And some of those people may have been poorer than a prime borrower. Sometimes they weren't poorer, but because of racial discrimination or whatever, they just had a lower FICO score. There's also some evidence on that, economic research on that. Anyway, they wanted to try to make home ownership possible for everyone. And that used to sound like a reasonable goal before the global financial crisis came. So they developed the secondary market. All right, there are many, many, many more notes up here that you can look at if you want to. Okay, let me leave them up there on Moodle for you to look at if you want to. Oh goodness, it's almost 3. Let's take a minute and do something else before class ends.